Hey everybody, this is Brent from Wolf on Wall Street Trade. I'm going to do a little something different with this video. Usually I really lay everything out and prepare everything, but I'm going to treat this like we're just sitting at a beach bar having a couple beers on a high top and chatting about the market with a laptop. So let's jump in. So first of all, this week the big event was, well, number one, the FOMC minutes were released and they were a little bit more dovish than the policy statement, but the big event was, of course, Jay Powell, the chair of the Fed, at the Jackson Hole Symposium in Wyoming, which is where he usually makes big announcements. So 2 years ago, almost to the day, at Jackson Hole is when Powell said, they're going to fight inflation and that he would trade a recession to defeat inflation. So the tone has completely changed. And he's basically said that the Fed is now going to start their rate cutting cycle. It won't be a cut, it will be a cycle. But as far as what he said, it was nothing new. The market has been pricing in a 100% probability of a 25 basis point rate cut at the September FOMC. The market hopes and dreams that it can get 50 basis points, but the probabilities didn't change at all after Jackson Hole. In fact, I think they went down a little bit from last week, so they're at something like 24% for a 50 basis point cut. We've got a whole slew of economic data between now and that September FOMC, and that will include the payrolls report, which will be the most important, CPI, PPI, PCE, all the important stuff, but the payrolls. So first, I want to give a quick shout out. If you go back a couple videos to my Stranger Signals video, there was a bunch of stuff about volatility. Now, volatility hadn't moved in a long time. I have a proprietary indicator that gives us a heads up, and hats off to a lot of my subscribers that took that trade because volatility is a beast to trade. So here is the VIX, and these cluster of yellow signals are the proprietary indicator I'm talking about that tells us that VIX is about ready to make a big move in the next 30 days. This move from close to close was over 200%, and from the close of the first day we got the signal to this high was 440%. I don't know how everyone did as far as subscribers who took the trade, but I know at least one of them had over 100,000 in profit at one point. But on this day, VIX was up 75% at one point, then it was up 25 and 35%. So you're running that on leverage. You're watching your P&L jump by $20,000-$30,000 in a half an hour on a trade like that. So my hat's off to everyone who took that. And once again, this ABI proves to be a really, really valuable and very high probability signal. Now, VIX came down incredibly quick. As a matter of fact, I saw a stat from Reuters that said when VIX goes above 35 historically, and it hit 65, by the way, and it's only done that 3 times in almost 4 decades. So a big, big move. But Reuters said when VIX is above 35, historically it takes 170 trading sessions for it to come back to its long-term median of 1760. It did it in 7 days. Why? The shorts. Oh my Lord, look at this. Hopefully you can see the screenshot, but this is VIX shorts. I mean, they just piled on. So that is why VIX came down so quick, but VIX is not a trending product anyway. So let's talk about the Powell pivot at Jackson Hole. It did nothing, like I said, as far as moving expectations, but it got the market a little excited. So here's the sell-off. This is when VIX exploded, August 5th low. We had volatility and backwardation. At this point, when volatility is in backwardation, that's extreme fear. Any kind of extreme contrarian, any kind of extreme in emotion in the market is almost always contrarian. So when you have extreme fear and you have volatility and backwardation, more often than not, that's a short-term low. And that's what we had. And by the way, we had a measured move for the S&P, and it hit that measured move on August 5th here at the low, plus we had that volatility backwardation. But the market rallied, and historically the market always rallies into Jackson Hole. Historically, more often than not, I think it's 5 times out of the last 7 years, it's a sell the news event. So it rallies in the Jackson Hole, which was Friday over here, and then it sells off typically after that, 5 out of 7 years anyway. So probabilities on that. Let me pull up QQQ real quick because I want to show you something. I want to show you the volume on this advance. Let me pull this up. So here's the volume, and what you'll notice is here's the average volume, 200-day, and all these rallies are on subpar volume. See this green volume? It's not even at the 200-day average. But then when we get sell-offs, the volume is increasing. Then we get this rally over here, volume's declining. That's the absolute exact opposite of what you want to see in a healthy market. In a healthy market, volume should increase on the advances, and then when you get a dip, volume should decline. It should come down. So what we're seeing here is not good, this price volume activity or trend. And we've been seeing it for a while in a lot of places, but it's not good whether it's QQQ, whether it's gold, whether it's Bitcoin. It doesn't matter. It's not a healthy thing. It's toppy price volume behavior. If we look a little bit closer, Thursday was a bearish engulfing candle. Here's Powell on Friday. That's an inside day, so neither of those days were very constructive, and the 2 days before were like small-bodied candles, almost like stars. Those are a loss of momentum, so that's what we're seeing right here. I want to talk a little bit about why the Fed is now moving toward cutting in September and starting the rate cut cycle, because it's been a rate hike cycle and then pause. We've been on pause for a while. Now it's rate cuts. So the Fed has 2 mandates from Congress. One is stable prices, so think inflation, and 2 is maximum employment, think jobs. One of the big things we got this week, and I've been talking about this for a couple of years now in the videos, is the payrolls revision. So for payrolls, and I've been saying this in a lot of videos, what we've been seeing is payrolls, just the establishment survey is soaring while the household survey is flat. And that's been happening for about 2 years now. A lot of us, me included, have believed that the Bureau of Labor Statistics, the BLS, has been overstating payrolls, and my personal belief is for political reasons coming into an election. But in any case, we got the first preliminary revision covering the period of, I think it's February of 2023 to March of 2024. And they revised down payrolls by 818,000 jobs. So yeah, they were overstating it big time. So if you average that out over that 12-month period, what they reported would have been 218,000 jobs a month gained. After that revision, what it actually was 150,000 jobs. Far, far, far fewer jobs added. And that is disturbing and troubling in its own. The fact that that department has a $750 million a year budget and is that far off is troubling as well. So on the stable prices side, this is inflation. This is inflation coming down. The Fed wants, this is core CPI, by the way. This is the COVID recession over here. We had deflation for a little bit. Then we got this massive surge of inflation. So it's coming back down towards their 2% goal. They feel pretty comfortable with the trajectory here. I'm going to say watch oil prices. That is, I don't think we're going to see anything like this, but watch oil prices. I'll talk about that a little bit more in a second. This is not the reason they're cutting. The reason they're cutting is jobs, and specifically the unemployment rate. And this is from the BLS, as you can see here. This is the unemployment rate. Do you see that trend? 4.3%, right? Here's another way to view it. So as the jobs market was recovering after COVID, unemployment rate very low. This is a change year over year, and you can see the trend is just moving up. Not only that, but it's moving up enough that it triggered the SOM rule. If you're interested, you can pause the video and read the part in yellow here, and this is from the St. Louis Fed's website. Claudia Sahm was an economist with the Fed. She wrote the Sahm Rule, and basically what it states is that if the 3-month average of unemployment ticks up 50 basis points above the prior 12-month low, then it is a signal of recession. Here is the Sahm indicator. It has been moving up, as you can see. There's 50 basis points. So it has triggered a signal that says we are in recession because unemployment is rising. This is why the Fed wants to and needs to cut rates as soon as they can. But remember, there's a 12 to 16 month lag in Fed policy. So if they cut rates today, that's not going to be felt in the real economy for 12 to 16 months. With the rate hike cycle, it was actually a much longer lag. And they will be cutting rates as home prices, as you can see here by the Case-Shiller index, right? Home prices are at all-time record highs with 6.5 to 7% mortgage rates. What do you think is going to happen to housing prices when the Fed starts cutting rates? They're going to soar. They're going to go up even more unless we have a recession. This also is from the St. Louis Fed's website, Fed database, right? And this is food. So record high prices in food, whether you're going out to eat, which is the line in red, or you're buying food at home, all-time record highs, huge inflation there. The only way that's coming down, again, is recession. If you've watched a few of my videos, you probably know what I'm going to show you now. This is the Fed funds rate, and this is a cycle that is almost as predictable as the sun rising in the morning. So the gray areas are recession shading. So this is the Fed funds rate, the effective Fed funds rate. This is a rate hike cycle. And the next thing they do is pause, right? Usually what will happen is the 2-year yield will go below the Fed funds rate during a rate hike cycle, telling the Fed that they've gone too far. They'll pause the rate hikes and they'll leave it there for a little bit. The next thing they do is cut rates right into a recession. Again, here is the great financial crisis right over here. Hike, pause, cut rates right into a recession. Again, hike, pause, cut rates right into a recession. That's the COVID crash. We're at hike and pause, getting ready to cut rates in September. I'll tell you a few things that I'm looking out for. Oil prices is one. And the reason why is the market wants to see the Fed cut quickly. They want to see the Fed cut a lot. This is why the Fed is going to be watching inflation. If inflation bumps up a little bit or it's not making progress, it's going to hamper their ability to cut rates or to cut as fast as they want or cut as much as they want. So watching oil prices is crucial, and right now I'll tell you why. Because oil is starting to act a little bit better. Now, rising oil prices were part of the reason that we had that bump in inflation the first half of this year, the first half of 2024. That little bump in inflation is the reason the Fed couldn't cut in June. And you might remember in December, the market was pricing in 7 rate cuts for 2024, starting in March. That's what the market was looking for. Then we got a bump in inflation. A big part of that was oil. So I'm looking at this oil trend, and what you see is lower highs and lower lows. I'm just going to trace out a few of them, but there was a trend of lower highs and lower lows, right? That's a downtrend. This one in particular is a sub-intermediate downtrend until just recently we get over here and make the first higher high. Then we get a pullback this week, and it looks like we're making the first higher low. So this is how a trend starts to change, that it transitions from going down to up by making a higher high, a higher low. The next thing would be to make a higher high, like say around $80. Oil hits $80, that's going to be problematic. I believe the Fed absolutely still will cut in September, but it may delay their next cut depending on what oil does. And we have 2 tankers that were just hit this week by the Houthi rebels in the Red Sea. So a lot of that traffic is not transiting through the Red Sea anymore. It's going around the tip of Africa, which is adding 40% onto costs of transport and adding about 2 weeks delay on timing. So if things flare up there, like Iran retaliates against Israel, which everybody's still waiting to see if that happens. There is a choke point in the Red Sea where it's almost, I think it's something like 2 miles. Iran could shut that down if they wanted to. So if things escalate in the Middle East, oil prices can go up, and I'll show you what will happen to rates. Okay, what you're looking at now is a 5-minute chart of the 10-year yield. So you can see 10-year yield coming down, bumping up a little bit before Powell, coming down a little bit after Powell. But that's not the point. Here's the point. I'm going to add USO for the United States oil in blue. And do you notice anything? Yes. Because energy prices drive inflation, and oil is used in everything. So whether it's making plastic for Coke bottles or the trucks that deliver the Coke bottles, all dependent on oil. And oil tends to lead yield. So if we go out a little bit to like a 4-hour chart, and let me just grab a little drawing tool. Remember, the red and green is 10-year yield. The blue line is USO for oil. Lower high in USO, right? The trend's turning down, yields follow. Higher low, trend's turning up, yields follow. Lower high. You see what I mean? And we've already got a pretty decent divergence there anyway. So anyway, that's something to watch, because that could slow down the Fed's rate cutting if we start to get a surge in inflation again, or a bump in inflation. And what will that do? That will make the unemployment situation worse, and it'll tip the economy further towards recession. The other thing I am watching is the dollar yen, USD JPY. It is the carry trade. So funds, traders, they use this carry trade, the differential in interest rates. They take those profits, they invest them in stocks. We have a bear flag over here that is just starting to break down. Let me show you why it's important. I'm going to add NASDAQ 100 futures onto this chart. And you'll see, because the sell-off that we saw starting around mid-July, part of it was this carry trade was really vicious. So you can see how closely they track, and you can see already that the NASDAQ and the S&P have run up away from this carry trade, while we have a bear flag here that is breaking down. The place I would watch this first, if this becomes trouble, it breaks down, to a new low over here below 142. What will probably happen is you'll see it in Japan first. You'll see it in Japanese stocks getting hit. Then U.S. stocks will get hit. So this is something to keep an eye on. The other big thing that is coming up this week is Nvidia earnings. So here's Nvidia just off all-time highs. Is this going to be another lower high like we had over here? That was a key reversal day. This was a huge bearish engulfing candle. Let me pull up just a little drawing tool. So what we have is a high, we have a lower high. Are we going to have a lower high over here? That's going to depend on earnings. Now, something that I find really interesting is that the CEO of Nvidia sold almost $170 million worth of his stock before this, little mini crash we had. That's a correction actually in the market, about 10% in the S&P. But he sold almost 170 million, I think 169 million right before that. That's not really a good look going into earnings. Now, Nvidia's they've blown away earnings the last 6 quarters, but the size of their beats on each consecutive one have been smaller and smaller and smaller. So that's what the market's going to be watching. You could see Nvidia actually beat earnings, but still come down. So this is going to be a big one. And it's especially important right now because investors are really, really underinvested in tech. They have been selling tech the last 4 weeks. Now, I've been seeing it on 3C charts. I've been pointing it out in my mega cap index. I'll pull that up real quick. So this is the S&P 500 in the red and green candlesticks, and this is an equal weighted index of the Magnificent 7 mega caps, right? Look what happened. They were leading the S&P until we got into mid-June, and then we saw this kind of breakdown right here. That started this whole sell-off. The carry trade was part of it. CTA's unwinding was part of it. Here's the August low. Here's the bounce. Notice where the S&P is relative to this area. It's above right now, right? But notice where the mega cap index is. It's below it. So we're seeing relative weakness in the mega cap index already. If we see a jog like this where it like negatively diverges with the S&P, there's a really good chance you're going to see the market come down again. And I think this is really going to hinge on Nvidia earnings. Now, if Nvidia earnings are good, what's going to happen is all these underinvested funds that are underinvested in tech are going to rush in. But if Nvidia's earnings aren't received well, their guidance isn't received well, they don't have as big of a beat, whatever it may be, then you're probably going to see more money flowing out of tech. And I've been seeing this on 3C charts too. So here's the 3C chart. This is underlying money flow. It's my proprietary indicator for SPY, for the S&P, right? We have a positive divergence over here. Stock price run, or the ETF runs up to all new record high. But look what 3C is doing, negatively diverging right into this breakdown. This is where we had all those signals, my video stranger signals. They were all coming in, in this area. So we do get this low on August 5th, and we do get a little bit of confirmation. But overall, we do have a negative divergence here. We did get this pop on Friday morning. This was from Powell because he was dovish, but he didn't say anything new. It didn't move rate expectations at all. But the point is that we're seeing increasingly more increasingly weaker money flow on this rally. I see it in SPY. I see it in the tech sector, which is the most important, most heavily weighted sector. Let me pull that up real quick. And same kind of thing as SPY, confirming over here, 3C's confirming. But then as we come into the all-time highs over here, look at big negative divergence. So money is coming out over here. This is distribution, price falls. We get a little bit of confirmation, but again, this is like, it's not horrible, but it's really weak money flow. This is a long-term chart, 4-hour chart, like major trend for Nvidia. Now remember, in the 2022 bear market, it was only half a year. Tech was the most hated. Mega caps were the most hated stocks. And they were getting sold really bad in December of 2022. It was just tax loss dumping. And I was telling all my members, these are being accumulated, right? They looked horrible because prices were going down sharply, but they were being accumulated. And these became the leaders of the rally for 2023 into 2024. But look, as we get into 2024, look what's happening over here. We're not seeing that confirmation in Nvidia. We're not seeing the same enthusiasm, the same strength and underlying money flow. If we look at some of the shorter time frames to get like more granular, this is that sell-off from mid-July, and 3C is confirming as it should. We see like a little price bounce here. 3C does not confirm it, makes a lower high. Price comes down into that August 5th low. Now we are seeing the trend move up, but very weak. I'm going to go down one more time frame and get a little bit more detail. Okay, so there is the August 5th low, and we're seeing, a little bit of confirmation in here, and then money flow just completely falls off right in this area. So I don't know if this has to do with earnings. I don't know, because it's kind of market wide. I'm seeing it everywhere. So I'm not sure it has to do with earnings, but this is going to be a really important earnings call, I think. And it's Wednesday after the close. Now, there are some things I love right now. If you're a subscriber, you know what they are. I'll pop a few out. Here is a 4-hour chart of gold futures. My subscribers listening to this, you know what I've been saying all year. I want to see a nice big consolidation in gold, and I think gold is going to do great as the year goes on. Look at gold, all-time new highs. The trend is good, higher highs, higher lows. Maybe it's going to consolidate a little bit. Gold's acting excellent. What happens when the economy slows down and the Fed is cutting rates? Real yields drop. Real yields are nominal, less inflation. So both those should be dropping. Gold trades opposite of real yields. It should be going higher. What else will do well when yields are falling because the economy is slowing down? Well, TLT. I know a lot of guys in our Technical Take Discord room have been looking at TLT for a while and have been excited about it. And my call has been like, yeah, I like it too, but just be patient with it, give it a little time. So you can see this kind of like, I had the trend line at $100.50. You can call it 101, you can call it 100, whatever, it doesn't matter. But you can see we had support here, support here, support here, support here. So when support breaks like it did over here, it becomes resistance. And you can see resistance here and now resistance over here. But if we take a really close look at what's going on right over here, I'm going to do it on a white chart so we can see it a little bit better. But right under this area, it's consolidating constructively. So this is a 60-minute chart. If I just draw in some quick trend lines, you know, we have like some kind of, this is going to be a little bit sloppy, sorry about this, but we've got some kind of big ascending triangle here. Price breaks out, and it looks like we've got another, trend lines aren't working very well, but either a symmetrical triangle or an ascending triangle, but it's coiling up. Look, I look at consolidations like this, like a spring building up tension or building up energy to release that energy. And where we want to see it release that energy is above, I can't seem to move this chart now, but above this 150 level. And that will happen, I believe, maybe like when we get the next payrolls report, which is the first Friday of September. So any bad economic data, but that's the one everybody's going to be watching, is going to send the long-term yields lower, and that's going to send the bonds higher. So TLT is something that I think will move with gold and will do very well, and it's getting very close. I think we're getting very, very close to just this being a buy. So I think I've finished my beer. I hope you enjoyed yours, and if you liked the video, please give it a thumbs up. And don't forget to subscribe. You can subscribe down here and turn on notifications so you know when new videos are coming out, or go to the website and you can sign up to get on any of our free content, free newsletter. You can do that at wolfonwallstreettrade.com, which I'll put in the video description, or the new website that we're moving to, which is thetechnicaltake.net. Where we have the Discord room that's active right now. So any members that are not in there, you want to be in there, just send me an email. Everybody enjoy the rest of your weekend. I hope you enjoyed the video. Members, I'll see you on Monday.